Hey everyone, welcome back to my channel. Today we are tackling a common accounting challenge, preparing a statement of cash flows. We will be using this practice problem as our guide, breaking down each step and explaining the logic behind it. By the end of this video, you'll have a solid understanding of how to create a statement of cash flows and feel confident in tackling similar problems. The following information is available for STX, a limited liability company. So we have the statement of financial position, that is the balance sheet. You can call it the balance sheet. We have for the year 2003 and for the year 2004. Normally, when it comes to the statement of cash flows, if you're required to come up with one, they will provide the statement of financial position for two financial years. That is the current and then the previous year. So we have this statement of financial position, 2003 and then 2004, non-current assets. As you can see, we have non-current assets at cost, and then non-current assets at their current values after deducting the accumulated depreciation from the cost. We have the current assets, inventories, receivables, cash at bank. We have equity and liabilities, capital and reserves, ordinary share capital, revaluation surplus, and then the retained earnings. Then we have the non-current liabilities, where we have the 10% loan notes, current liabilities, trade payables, and then income tax. We have the summarized statement of profit or loss for the year ended 31st December 2004. That's the current year, where we have profit from operations, finance costs, and then this should be profit before tax, because when you get a profit from operations minus the finance costs, then you come up with what we call the profits before tax, then the income tax expense, and finally our net profit for the year 2004. That is the summarized statement of profit or loss for the year 2004. Then you have some additional information. Note 1, it's about a disposal of a non-current asset which had a cost of $800,000, a carrying value of $350,000, which was sold for $500,000. There was revaluation surplus that arose from the revaluation of some land. So we have to find out how much is that surplus. That revaluation surplus increases the value of non-current assets. Then the additional loan notes were issued on 1st January 2004. Interest was paid on 30th June 2004 and 31st December 2004. Dividends paid during the year amounted to $750,000. Required prepare the company's statement of cash flows for the end of 31st December 2004 using the indirect method, adopting the format in IAS 7 statements of cash flows. So we are required to prepare the company's statement of cash flows in accordance with the IAS 7, that is statement of cash flows, using the indirect method. Now the statement of cash flows, that's a financial statement that shows how a company's cash position has changed over a specific period. Of course, the statement of cash flows tracks the flow of cash into and out of the business, providing valuable insights into the company's liquidity and financial health. Don't forget that the statement of cash flows has three main sections, i.e. the operating activities, where I will look at the cash that has been generated from the company's core business operations. We have investing activities, where we'll look at the cash that has been used for investments in assets and that cash that has been received from the sale of assets. Then finally, the statement of cash flows has the financing activities section, where we'll look at cash flows related to financing the business, such as borrowing money, issuing shares, and paying dividends. Those are the three main sections of the statement of cash flows. So, what is the approach now? Normally, what you have to do, you have to read the requirements of the question, noting the year-end date. The requirements are very clear. We are required to come up with a statement of cash flows for the year ending 31st December 2004 using the indirect method. So you write your heading STX, statement of cash flows for the year ending 31st December 2004. Of course, don't forget the three headings that the statement of cash flows is prepared in three main headings. We have to show those headings, the operating activities, the investing activities, and then financing activities. But according to our information, this is the draft. This is my format, following the information we have. So under the indirect method, cash flows from operating activities, we start with the profit before tax. Where do we get the profit before tax? We look at the statement of profit or loss. For the statement of profit or loss, we see a profit before tax of 2,350. So bring that profit before tax. It's what you start with the statement of cash flows. Then we have to make some adjustments. We have to adjust this profit, and the adjustments we make that of the finance costs, that is the interest expense. When you look at the statement of profit or loss, you see there was finance cost of 300, which was deducted from the profits from operations. So we have to add back 300, that is the finance cost. That 300 has to be added back. So we have to adjust the profits by adding back the finance cost. Then depreciation expense. Depreciation is a non-cash expense which is accounted for when arriving at the profit before tax in the statement of profit or loss. But one thing you need to know about the statement of cash flows, that the statement of cash flows is prepared on a cash basis. We are interested in cash movement due to the fact that depreciation expense is a non-cash item. We have to eliminate it by adding it back to the profits before tax. Depreciation expense, I will look at the additional information. It's not given. In some scenarios, you find the depreciation expense given, but in this case, we don't have the depreciation expense that was charged in the statement of profit or loss. But we have some information about the accumulated depreciation, the opening balance, as well as the closing balance. So we can use this to arrive at the depreciation expense. So you have to come up with a working. For this depreciation. Oh, sorry, this is the statement of financial position. So I'll use the depreciation figures accumulated to arrive at the depreciation expense for the year. So I'll go to my workings. The opening balance is always on the credit for accumulated depreciation, and that balance is 4,800 as per the balance sheet. Then the closing balance, that is 5,600. So enter the opening balances, the opening and then the closing balance, enter them. Then go through the additional information. you see there is an asset disposal, non-current asset disposal. When you dispose of a non-current asset, you have to write off that asset from the books of accounts of the company. The cost of the asset has to be written off from the non-current asset account, and then the depreciation of that asset that has been disposed of should also be written off from the accumulated depreciation account, because the asset has been disposed of. So why do you keep that depreciation in the books of accounts? Remember, the accumulated depreciation account records depreciation of assets from the time these assets were acquired to date, but now this asset has been disposed of, so we have to write off its depreciation. So what we have to do is to debit the accumulated depreciation account. We have to debit it with the amount of the accumulated depreciation for the asset that was disposed of. Now this asset had a cost of 800, though by the time it was disposed of, its carrying amount was 350, meaning that this asset had an accumulated depreciation of 450. So that 450 is a debit in this account. When you balance up this, now your balancing figure will represent the depreciation charge for the year 2004. So this is 6,050, and then this will also be 6,050. So the depreciation charge is 1,250. That's the depreciation charge for that year. The expense in the profit and loss account, that was 250. So that's what we are going to show up there as our adjustment to the profits. Oh, my totals. Remember, when you're preparing these accounts, when you're doing the balancing, the totals will always be in the same line. Don't forget that. So it was something I was forgetting. Okay. So yeah, that's our depreciation. The balancing figure is 1,250. So we add back this to the profits because it was a deduction, it's an expense in profit and loss. So we show it as an addition here, the statement of cash flows, because it's a non-cash expense. Profit follows on disposal of non-current assets. There was a disposal of a non-current asset. Its carrying value was 350,000, but it was disposed of for 500,000. So here the company made profit. It's a profit on disposal. It's a loss to show it, and now this is a profit. So it's a profit. It's a profit. How do we arrive at that profit? It was sold for 500. Its current amount was 350. So the company made a profit of around how much? Around 150. That was the profit that was made, 150. But now this profit is a minus. We are going to deduct this from our profit before tax, because this profit increased the profit before tax in the statement of profit or loss. It's an addition. It's presented under the other incomes. So in the statement of cash flows, we eliminate this profit by subtracting it, because it's a non-cash profit. So I'll eliminate it by subtracting it. If it was a loss, it will be an addition in the statement of cash flows. Now after these adjustments, look at the changes in working capital, look at inventory. What happened? Inventories 2003, the inventory figure is 3,800, 2004, 3,400. There's a decrease of 400. We have a decrease of 400 in inventories, decrease in inventory 400. Decrease in inventory, that's a cash inflow. If the inventories of the company decrease, then that's a cash inflow. It means that either the company is selling off its inventory and they are receiving cash, so that's a decrease, it's a cash inflow. Look at the trade receivables. What happened to trade receivables? Trade receivables increased by 900, that is from 2,900 to 3,800. So that's an increase in receivables. Increase in receivables, that's 900. Increase in receivables, this is a cash outflow. When your receivables increase, the business has no cash because it means they are selling more goods but on credit, so that's a cash outflow. Increase in payables, did the payables increase? Let's confirm. Yep, payables increased by 500 from 3,200 to 3,700. That's increase in payables 500. Increase in payables are liabilities. When liabilities increase, then that's a cash inflow. So the 500 is a positive, it's a cash inflow. So those are the changes in working capital. So what you have to do, you have to do the addition and then the subtractions. We see what we have. So we have cash that has been generated from operations of 3,750 to $3,750,000. That is the cash generated from operations. Then we have to less the interest paid or the finance costs that have been paid, and then the income taxes paid. We can start with the interest paid. There is a note about the interest payment. The additional loan notes were issued on 1st January 2004. Interest was paid on 30th June 2004 and then 31st December 2004. So the finance cost you see in the statement of profit and loss, that interest was paid because in the statement of financial position we don't see any liability for interest expense, meaning that the 300 was paid during the year. So the interest paid, this is 300, interest paid 300. Income taxes paid, how much tax was paid? Let's find out. The 2003 income tax liability was settled at the amount provided for at 31st December 2003. So in 2004, the company settled the tax liability of 2003. How much is the tax liability of 2003? That is 600 as per the statement of financial position. So that's the amount of the tax liability that was settled in the current year. So the company paid 600, which was the tax liability of the year 2003. That tax liability was paid in 2004. So what do you do? 3,750 minus 300 minus the 600. This gives you now what we call the net cash flows from operating activities. This gives us the net cash flows from operating activities. So the operating activities of this business, of this company, generated 2,850,000. That is the cash that has been generated from the company's core business operations. From there, I move to investing activities. where we look at the cash that has been used for investments in assets, and then that cash that has been received from the sale of non-current assets. We already know that the company disposed of a non-current asset and they received $500,000. So that's a cash inflow, proceeds from sale of non-current assets. We have 500. That's a cash inflow. Purchase of non-current assets. You see, we have to come up with a working for this. We have to find out how much was incurred, how much was paid out to add on more non-current assets. Let's try to find out this. Purchase of non-current assets. Purchase of non-current assets. So you'll use the information about non-current assets in the statement of financial position. You have the cost of valuation. At the start there was 8,000 cost. Then at the end we see 11,000. But don't forget that during the year the company disposed of some non-current assets, and then there was also disposal of a non-current asset. So let's move to the working. Opening balance. Assets have a normal debit balance according to the rules of double entry. So the balance brought down, this is 8,000 as per the question. The closing balance is 11,000. I've used positive values. Then the asset that was disposed of during the year had a cost of 800, so we have to write off this asset has been disposed of, so you have to credit the non-current asset account. Then look at the balance sheet or the statement of financial position. We have been told that during the year assets were revalued. Assets were revalued. So due to the fact that assets were revalued, find out how much was the revaluation surplus. You see there is an increase in the value of revaluation surplus, or in the balance of revaluation surplus, from 1,000 to 1,500, meaning that there was a revaluation surplus of 500. So this is an increase in the value of non-current assets. So revaluation 500. Assets increased in value as a result of revaluation. So balance up this account. When you use costing values, then you ignore the depreciation. You only use depreciation in your workings if you had used current amounts, but now you have used costs, so I'm ignoring the depreciation this working. So the balancing figure will be how much? The balancing figure will be how much? Is there anything I'm leaving out? Just check, just confirm. 8K, then 11. I think I have the 8,000 and then the 11,000. Do I have them? Yes. Disposal, the asset that was disposed of had a cost of 800. I think I also have that. And then the revaluation is 500. Okay. Okay. So now how much is the balancing figure? Oh, this should be 11,800, sorry. This should be 11,800. I don't know why I was subtracting. It's supposed to be 11,800. Then minus 8,000 minus 500, giving us a balancing figure of 3,300. So that represents the additions that were made during the year. So purchase of non-current assets as per the working, we have 3,300, and that's a cash outflow because we are using cash to acquire more non-current assets, so it's a cash outflow. So you add and you finally come up with the net cash used in investing activities, and that is 2,800 net cash used because the figure we have is a negative, positive 500 plus negative 3,300. We end up having a negative 800, so that is net cash used in investing activities. Then cash flows from financing activities, proceeds from issue of loan notes. There was an increase in loan notes, meaning that the company acquired more loan notes from 2,000 to 3,000. There is an increase of 1,000. So proceeds from the issue of loan notes, that's an increase in the non-current liability that falls under financing activities. That falls under financing activities. 3K minus 2,000. That gives us 1,000. Dividends paid, that's per the additional information. Dividends paid 750. Dividends paid 750. Dividends paid 750. Dividends paid, that's a cash outflow and financing activities. Payments to the shareholders who provide finance in form of share capital. So that's it. Sometimes you find that we have issue of shares, but in this case, when you try to look at the information given, the ordinary share capital is the same, 2003, 2004, it's 1 million. So there was no any issue of shares that was made during the year. If the ordinary share capital balance had increased in 2004, then of course we have to find out the proceeds that were received from the issue of shares. But in this case, we don't have, the balances are the same. So these are the only financing activities we have. So 1,000 plus negative 750, this gives us a 250, which is positive. It's positive 250, representing net cash that has been generated from the financing activities. So now what we have to do, we have to get a net increase or decrease, whereby we have to get it to 850, the net cash from operating activities. We add the net cash from investing activities, which is a negative. Then we add the net cash that has been generated from financing activities. So we have a positive 300. We have a positive 300, meaning that this is what the company has generated. This is the net increase in cash and cash equivalents. So the company's cash position has changed by 300,000 over a period of 1 year, from 2003 to 2004. The cash position has changed by 300,000. In fact, it's an increase of 300,000, because when we try to look at the way how they have performed, the operating activities, the investing activities, and then financing activities, this is what they have generated. Okay, their cash position has increased by 300,000 throughout a period of 1 year. Then we have to add the cash and cash equivalents at the beginning of the period. So look at your cash at bank at the beginning of the period. That is the 2003 balance. That's 100. That's 100. So we bring that 100. You add it to the net increase in cash and cash equivalents. When you add these two, you get 400, and that should be your cash and cash equivalents at the end of the period. Let's try to check and see the balance sheet. Yes, cash at bank 400, That is the closing cash bank balance. So this is what we have here as our cash and cash equivalents at the end of the period. So you see this statement of cash flows, it shows you how the company's cash position has changed over a specific period. So we see at the start, the cash and cash equivalents balance was 100, but by the end of the year, we see it's 400. So the cash position has changed by $300,000, and we can see where this $300,000 is coming from. There was a net cash generated from operating activities of $2,850,000, but that cash was used in investing activities because the net cash used in investing activities is 2.8 US dollars. But then financing activities, we managed to generate just $250,000 as per the statement of cash flows, making it 300,000 as a net increase. When you add this 300 to the 100 we have at the start, we have 400. So that's the question. That's the statement of cash flows. You always have to read the requirements, noting the year-end date. Don't forget that the statement of cash flows has the main sections: operating activities, investing activities, and then financing activities. We have to look at the cash and cash equivalents, the balance brought forward, the balance carried forward, and the movement, of course. The movement has been 300,000 during the year. Then the statement of profit and loss, you have to look at this statement of profit and loss as well. You need the profit before tax from this statement always. You need the finance costs as well. Then you also need this income tax expense, because it's going to guide you on how to arrive at the tax that has been paid during the year. The statement of cash flow, statement of financial position, you have to look at the inventories, receivables, and then the payables. Look at the borrowings under the non-current liabilities. Also look at your share capital and share premium as well. The additional information normally provides information about cash inflows or outflows, for example, sale of property, plants, and equipment, non-cash items, for example, depreciation. So you have to go through the additional information as well. So that's it all. That's our practice problem, which I wanted to use to see how we can come up with a statement of cash flows. I believe now you have an understanding of how to create a statement of cash flows, and now you can tackle similar problems. Thank you so much for learning with Senior Huntington. Bye-bye.